Hey, what's going on, everybody? It's Friday, April 15th. It's not tax day. Tax day is Monday, April 18th. How's everybody doing? Hey, I want to wish everyone a good Friday. Happy Passover. Happy Easter. Whatever you're celebrating. Happy Friday. All right. Markets were closed today. We ended the week on a soft note yesterday. Got some updates for you. First, really incredible, I want to talk a little bit about market sentiment. This week, the AAII Weekly Sentiment Survey for the week ended April 13th. That showed bullish sentiment was like 15.4%. That was the lowest reading of bullish sentiment in 30 years. All right, you had to go back to 1992. I went all the way back through the data, and we have not seen a week with this low of bullish sentiment since 1992, 30 years. And what's even more incredible is the bull-bear spread. When you take the bullish sentiment number minus the bearish sentiment number, that is the most negative we've ever seen. That is a record negative number. It was like minus 36 or something like that. So, you know, it's some extremes, to put it mildly. Some extremes in that sentiment survey. Now, I've always said that these sentiment readings, they're not necessarily precise timing indicators. They give a general, kind of a general snapshot of market psychology. But, if you want to be a contrarian, you got to look at these things just to get an idea of what the sentiment is out there, what the market psychology, what investor psychology is, and it's no surprise. I mean, we have inflation, the highest inflation in 40 years. We have Fed about to go on, a super aggressive hiking cycle. We have a Fed about to go on this quantitative easing, quantitative tightening, as everybody is calling it. We got the war going on. I mean, there's a lot of negatives. So it's easy to understand why sentiment is in the toilet, which it is right now. But I like it. I mean, I'm a contrarian by nature, so when I see something like that, it gets me very excited. Let's go over some of the other numbers. First, the fiscal flows, they're looking good. They're strong. I mean, we're averaging right now, we're trending towards about a 630 billion month for the month of April. That is extremely good. I mean, we had a 633 billion month spending month last month in March. We had a 609 billion spending month in February. So these are good, strong numbers. Like I said, you have to go all the way back to July 2021 to see numbers this strong, to see monthly spending numbers this strong. So fiscal hasn't really decelerated very much. It certainly has decelerated from last March, March 2021, when we had the 1.9 trillion stimulus, or whatever the stimulus was back then. Yeah, for sure, the year-over-year comparison is down by by around 400 billion, 370-something billion. But nevertheless, the monthly spending numbers have held up. I mean, when you're talking about 600 billion a month, that's 50% more than what was the average in the pre-pandemic period, during the Trump presidency. And he, put through a lot of stimulus himself with tax cuts and military spending. We were averaging about 425 billion a month, and now we're 630 billion a month. I mean, that's very strong. Granted, inflation is a subtraction to economic growth. It's a net transfer of income. It goes outside the country. The United States runs large trade deficits. So that's a net transfer to the foreign sector. Prices, import prices are higher, etc. Domestically, it's just a redistribution of income. You're having income flowing from consumers to producers. And so that is not a subtraction. That's just a redistribution of income. This is the thing a lot of people don't understand about inflation. I mean, it's like there are winners and there are losers. You know, the losers are obvious. It's us as consumers. When we go to the grocery store, we put gasoline in our cars, we have to pay more money. But for oil companies or for farmers or food producers, they're seeing higher profits and higher margins. So it goes to them. Similarly, rates are also rate adjustments are a redistribution of income. When rates go up, it flows to creditors and savers, and it is at the it is a subtraction for debtors, people in debt who have to service debt. It's just that again is a redistribution, of income in the economy. But it is an overall negative for the reason I mentioned, which is the net transfer of income to the foreign sector, and that goes via the trade deficit. Let's talk about the banking numbers. Actually, I didn't think they were going to be posted today because it's a holiday, but they were put up. That's the Fed's H.8 release. If you Google that, H.8, you can get that. Another big week for loans, up 40 billion. Loans now growing at the fastest rate in 19 months. Total loans outstanding is at an all-time record high. We actually saw a jump, a pretty substantial jump. I think it was about 20-something billion in commercial and industrial loans. I mean, that might be tied to the energy sector, or it could be, again, firms replenishing inventory. If that's the case, and I don't know right now, it's just, that was the case in the fourth quarter of 2021, and I was talking about that. I told you that big upturn in commercial and industrial loans were probably tied to inventory accumulation, and we're going to see a big jump in inventory accumulation, and I said that was one sign that the supply chain issues were abating. And we did see a huge, in fact, it was a record, by far, a record increase in business inventories in the fourth quarter of 2021. Now, I was a little bit concerned about that because I said, they finally got their inventories after, a year and a half of the pandemic and the supply chain. They finally got their inventories, but now what if they can't sell that stuff? What if it sits on the shelf? That's going to translate into losses. But we're seeing again a pickup in commercial and industrial loans, and like I said, maybe it's tied to the energy sector, but it could also be tied to another burst of inventory accumulation, which I think that would be a positive sign. It means, people are and businesses are running out there to get product. There's demand for product, there's demand for supplies because of the situation that has been very, very difficult for 2 years in terms of getting inventory. So that would be a positive sign. I think it's a positive sign for earnings. I spoke about the banking sector last week, and it's been under a lot of pressure. Those stocks, they've been hit pretty hard. It's totally understandable. I mean, with the sanctions, okay, and rate volatility. But look, this trend of rising loans, I said, as soon as the Fed, and it's already happening in spite of the fact that we haven't even seen the Fed engage in its so-called quantitative tightening yet, the tightening which ostensibly is going to result in a reduction in reserve assets. And once that happens, if you think the loan growth is happening quickly now, and it is, it's the fastest growth in 19 months, it's going to accelerate even more. And you know what that means? I mean, these loans are much higher earning assets for the banks than ridiculous, unnecessary trillions of reserves just sitting there on the bank books which earn practically nothing. I mean, so I think the future looks really, really positive. I mean, yeah, the market now is discounting the negative impact of all the aforementioned things, you know, like I said, the sanctions and everything else, and banks having to take charges against potential loan losses and transactional losses and stuff like that. But man, I just think you got to look forward. You got to look ahead. I mean, it's all about, you know, what is going to happen, not what has happened. You know, the old saying, hey, do you drive your car by looking in the rearview mirror? I don't know about you. And I'm sure these self-driving cars don't do that either. I mean, they check out what's out there in front, and that's what you have to do. But so yeah, sentiment is crazy bearish. That is totally understandable. Put-call ratio has been hovering in the 0.9 level on the CBOE. I think probably we need to see some kind of capitulation here, like a big down day with big volume where you get a spike, maybe a couple of days spike in that put-call ratio to call a bottom on this thing. Last week was a little bit disappointing, I have to say. I thought we maybe bottomed out and could start to see a rally get started again, but Thursday, you know, that was a weak day. That was a weak day. I mean, we basically gave back everything that the market tried to rally on Wednesday, and Thursday it basically gave, or at least NASDAQ gave everything back. So there's still a lot of worry out there. There's still a lot of concern. And again, I said that we may have to see, let's get through the Fed meeting on May 4th. Let them raise those interest rates. Let them say whatever they're going to say about reducing the size of their balance sheet. And, you know, this has been so built in right now. This has been so anticipated. You know, you see where rates, 10-year yields are. I mean, we've got the rate hikes going out through 2023 already priced in. So let the Fed make their move, and I think that could be a catalyst for the turnaround. So anyway, that's it. I want to wish everybody a happy holiday, whatever you're celebrating, and hopefully I'll see you tomorrow. Bye.